There's a reason why high net worth top investors are doing this, and it's not available to everybody.
If you look at the investment landscape out there, you essentially have two options, public markets or the private markets.
Well, if you're a private company that's doing really well and you're like a cash cow machine, why go public? And then unfortunately, just a normal investor wouldn't have access to that. You're gonna get crumbs left on the table. Private markets are no longer reserved for institutions. That's where we come in. That's why we developed this portfolio. If you have the on your side, then this could be a fit for you. Private investments such as private credit, private equity, friends and family deals, these are not appropriate if you are starting out building your wealth. However, if your net worth is approaching 10 million plus, private credit, private equity have very strategic advantages to them. Devin, give us a lay of the land on what is private credit, what is private equity. And it's definitely not what most people think about their friend who just started a company and they're suddenly in a private equity because they threw 50,000 in it. Let's go high level, simplicity, but give us the real lay of the land.
Sure, yeah. So taking a step back. So if you look at the investment landscape out there, you essentially have two options. You can invest through the public markets or the private markets. Within the public markets, this is what we know. This is the S&P 500. These are public stocks. It's the Amazons. It's the American Eagles of the world. We know this quite well these days. The public fixed income or the public bond markets are bank loans, corporate bonds, community bonds, things like that. So essentially what we're talking about here is ownership stakes, that's equity, that's stocks, and then lending investing. And that's loans, that's bank loans, and that's bonds. So that's the public side. On the other side of the wall are private investments. Matt, what would you say is the size of the public markets right now?
Yeah, so we look at the total US stock market as of mid 2025, it fluctuates between $62 to $63 trillion. It's pretty crazy. The S&P 500 alone is 53 trillion. When you think about why is it hard to beat the S&P 500, well, it's 80% of the, and just in the 500 companies, and there's thousands of companies listed, that's 80% of the total market.
Well, that's why the S&P 500 is a good indice or
that's why hedge funds can't beat the S&P 500. That's why a lot of private markets probably can't beat this. Actually, some private markets have, but that's why we're going to talk today. But it comes with a lot of risk, which is the whole premise of this podcast. Yeah, but so private markets, the data is not as easily accessible. So we're looking about 12 trillion at the end of 2023, and then it's expected to grow over 15 trillion in 2025, 18 trillion by 2027. So it's definitely, growing. Just to be specific about private markets, we're talking about Blackstone. You can name some of the other big firms.
KKR, these are the big private equity private credit firms. Yeah, so for reference, so the public equity markets, it's 60 trillion plus or minus. I believe the public debt market for non-governmental debt, it's about 8 to 10 trillion, something like that. And then flipping over again to the private side. So private investments is anything that's not essentially sanctioned by some regulatory body to sell to the public, to sell to retail investors. Private investments are, I'm speaking generally here, but only allowed to be purchased by accredited investors or folks with significant net worth and liquidity. And incomes as well. So what does that mean? So similar, on the public side, we have public equity and public credit. On the private side, we have private equity and private credit. We don't typically use those terms like that, but we know private equity and private credit. Those are kind of more popular over the last 10, 15 years, something like that.
I think this will help put it in an overall context. Yep. If you look at the total financial assets of the U.S., you're basically looking at, this is as of quarter one of 2025, according to the Federal Reserve. So you got financial assets in America of about 129 trillion. You have non-financial assets of 61 trillion. And then you have liabilities of about 21 trillion. So leaving about 159 of net worth. So when you look at the deficit in the US and you look at, okay, well, what are the assets in Americans hold? It's still scary. It's not nearly as scary because that far exceeds the deficit. So we're looking at that 159 of trillion of net worth of America. And then you look at where the private equity market, it's less than 10%, right? So this is a very exclusive, scarce opportunity when we're talking about true private equity and private credits. Like in the US, I think it's between 1.5 to 3 trillion. That's even growing. But there's a reason why high net worth top investors are doing this, and it's not available to everybody because it is a small subset, less than 10% of total assets.
Yeah, but it's growing, right?
Absolutely.
It's growing fast. So why is this important? Because in the past, in order to access robust capital markets, companies, growth companies especially, needed to go public. They needed to IPO to access the retail markets and capitalize with billions of dollars if they needed it. There was a lot of capital held in, again, on the other side of the wall in the private markets now. What that means is that a lot of companies these days do not have to go public. which is fine for them because they don't have these onerous regulatory restrictions. They don't have to report earnings quarterly. They can choose their investors. There's all these reasons.
They don't have to go through the SEC.
Exactly.
To hit the IPO, and then after all the stringent regulation and compliance oversight. There is still that in the private markets, just not
nearly as much.
It's
a tiny fraction of the work that it takes in the cost. So companies are staying private longer, and that's great for them and their employees generally. But that's not so great for individual investors. Let's call it the top 50% of US households. Companies like SpaceX, OpenAI, Stripe, there's a bunch more that are 15, 20 years ago would absolutely be public companies. Today, they are not because they don't have to access those markets. Investors and money managers would like to have exposure to those companies, but they can only get that through the private market. So that's why this is important to anybody in the industry, to our higher net worth clients. Yeah. Did I miss anything there?
No, absolutely. I think that's a good high level for sure. So what exactly, like, let's just do basics. Like, so private, when you go purchase a stock that's publicly traded, you're now a part owner of that company. When you go purchase a bond that's publicly traded, you are letting that company borrow money from you, and they're returning your interest at a certain cadence, and whenever that matures, they're recording your principal. Those same concepts apply. Private equity would be similar to a public stock, just on a private level. Private credit would be similar to a bond, just on a private level. So let's go a little bit deeper on those. Why do these exist, and why have the returns in the short period of data that we're looking backwards, why have they been so good?
Okay, so this is a big topic. I'm going to try to streamline it. Why they exist? Like in any market, there can be holes in them. So in the capital markets, certain companies had access to public funds, to public money, to public investors. Others didn't for various reasons. So we don't need to get into that now. They had access capital via the private markets. And this is when firms like KKR is the big one. Other firms kind of sprouted up in the 80s. This is the big kind of deals with RJR Nabisco and the leveraged buyout firm starting to borrow money and invest privately. And there's a whole story behind that. We don't need to get into that. Why is this important today? Again, it's because a lot of these companies are not going public. Therefore, the vast majority of the investor base, i.e. the vast majority of our clients, do not have access to the OpenAIs, to the SpaceXs, the XAIs of the world. Private markets can offer that access in various ways. And it's not just those super sexy, super large companies that are growing like crazy and that we all know and use on a day-to-day basis. It's also, HVAC company roll-ups. It's, restaurant conglomerates. It's all these
dentist practices.
Yeah.
Jersey Mike's.
Anything. Yes.
Jersey Mike's. It's sports teams.
Sports is a big one as well. So what that leads us is it's essentially a diversification play where folks with capital, investors, don't have access to those public companies. So how do you get that? It's via the private markets. And to your point earlier, private equity, again, is this taking ownership, just like public equity. If you take ownership at a company, it's not widely available to the public. Private credit is the same thing. You're lending money, but it's not via banks or via investment banks as well. So why is that important? Because the private markets offer access to certain high growth companies that are not available in the public markets as they stand today.
Just to be clear, like I would personally recommend and do keep like 90% of my net worth in public markets. I mean, and we're not talking about like brand new, like sexy IPOs. We're talking about like that S&P 500 type, large cap, mid cap, small cap, some international exposure of big companies that have proven consistent results and, diversifying under that. The attraction to IPO now, unfortunately, is almost like a wealth transfer, unfortunately, of poor people to rich people, if you think about it. Because like a company IPOing right now, and literally the last couple of years have shown this, I don't know the stats on this, but it's like we did this before, and it was like over 2/3 of the company that IPO'd like lost a significant from their IPO price. These companies were private initially. A lot of high net worth investors put into them. They grew exponentially. Now they're going on the public markets at a high price. All the lower middle class people are like, oh, I can get in on XYZ. They're putting their money in. The rich people are offloading their profits after a time period. Then the thing crashes. And then the poor people that put their entire net worth have now like lost even what they had. So when you look at private markets that stay, it's like if you're a private company, why would you go public? Well, maybe you need to get chips off the table for your original investors. Well, if you're a private company that's doing really well and you're like a cash cow machine, why go public, right?
Yep.
And then unfortunately, just a normal investor wouldn't have access to that.
Exactly.
So that's my kind of 2 cents on that. So you have to be really careful because as a normal investor, you're not going to get, it's kind of like the bond market. You're going to get crumbs left on the table. But there are funds, there's conglomerates, and this is what we've developed the EWA from a private equity and private credit standpoint, where you're pooling your money with billions of dollars, so you're actually getting the good investments, the good companies that are staying private. The downside of this is really liquidity. So this is not giving your friend 50 grand because of his tech startup or a new drug, a pharmaceutical, which has to go through all kinds of regimented FDA approval. You're putting money into companies, and typically private equity, they have every 3 to 5 years, they're going to want to like get astronomical returns and then turn it around. And now the company's even set to do greater, and then another private equity company will come in. With these kind of funds, you're not going to see returns until the life cycle of these deals occur. Maybe it's 3 to 5 years. The downside, if you're an investor of going into this kind of portfolio, the reason we recommend is like, if you're 10 million plus, generally speaking, your liquidity needs are not the same as someone that has like $1 million of liquid net worth. So that's why we've set our minimum at 10 million plus.
Yep.
It comes with higher risk, but also comes with an expectation of higher returns. And the trade-off is liquidity. You can't get the money like that, like you could if you sold like Tesla stock or Apple stock. You have to wait it out. That's the trade-off, is really the liquidity for the higher returns. The higher returns aren't guaranteed, but historically, some of these like private credit, especially compared to the public bonds, have crushed it. Like even the fees can be pretty high on this stuff, because if you're a private company and you need capital and you don't want to give equity away, well, maybe you're handing out a 12% interest rate for 5 years. And that's a no-brainer for an investor. Is like, I can get 3% in the bank or 12% in this. Not a for sure deal, but it's likely this company is doing well. And if you're that company, you're like, I don't have to dilute my equity. Look at the profits we're growing. Of course, we can afford a 12% interest rate. So that's just like high-level concept, and why we put the guardrails around why we're only recommending this to clients. And within that portfolio, it's a 15% ratio. So for example, if you're an 80-20 investor, 80% of your money's in equities, you're going to have 12% in private equity fund, 3% in the private credit fund. We're also going to have an overlay specifically mirroring those. So if you do need liquidity, if you're retired, that we don't have to sell specifically to that private equity or private credit fund, so we can allow the life cycles to occur as well.
Yep.
And if you're 100% equity, 0% bond investor, then all 15% of that would be in the private equity fund, 0% in the private credit fund, just as an example. So that's a high level overview of how this works. I want to go into more detail. Private equity is not a friends and family startup. This is not a private credit. It's not angel investing. We kind of talked about this internally. You did this like chart, but walk us through that, like from the left to right, as far as the stages and the risk versus reward factors.
If you think of investing as a continuum of options, and it's generally thought of as like a spectrum of risk and return. So if I can sum up finance and investing into one kind of slogan, it's risk versus return. So the more risk you're willing to take on, the higher returns that you can expect, like you mentioned earlier, right? On one end of the spectrum is cash and cash-like securities, like treasuries, for example. Very, very low risk. In fact, you could argue that it's no risk, but the returns are quite low. On the other end of the spectrum, it's maybe something like I would never recommend this, but a crypto coin, right? Where incredibly high risk, but potentially incredibly high returns. We're talking 1,000% in a day or something like that. On that spectrum, I would put public equities, the large Mag 7 or S&P 500 stocks, somewhere, let's call it the 80th percentile. Somewhat high risk in terms of volatility, but also you're expecting 8 to 10% returns per year. In between cash and those stocks, I would say we would put somewhere your average corporate bond, right? Let's say Unilever is a borrower, right? The risk is fairly low, but they're only going to yield 4, 5, 6% right now, versus treasuries, which are, 4.5, something like that. So on that spectrum, it starts low risk, low return, all the way up to high risk, high return. Where do you think we would slot in private credit, private equity on that continuum? Because then adding this exposure to potential EWA client portfolios, really it comes down to like additional diversification on that spectrum, so to speak. So where would you say that
if you're a client that hasn't developed financial independence under 10 million, I would put private credit and private equity like higher, the highest risk, even both of them, even private credit.
Absolutely.
I'd put more than S&P 500, just because like you as an individual needing that in the time frame it's not intended to is probably pretty high. Now, if you're a high net worth investor and you've got time on your side and you've got the reality of you don't need this money in any given time in the near term, in 5-10 years even, I'd put private credit probably at or right below like long-term stock investing, and then private equity definitely above that as far as more risk, more return.
Yep. Okay. I would agree. So what does that mean for our clients with 8 figures or more of liquid net worth?
Yeah, I'd say private markets are no longer reserved for institutions. They require institutional discipline. That's where we come in. That's why we developed this portfolio. I'd say secondly, if you've already won the wealth game, this isn't more risk, it's a different kind of risk. It's smarter risk. And that's again where the portfolio comes in. And then third is if you have the liquidity game the time frame game on your side, then this could be a fit for you. And we're gonna, for our existing clients or new clients, we're gonna walk you through. And we're not gonna recommend this for everyone. This is an option that we believe is a fit for a certain kind of clientele. And if you're interested, please reach out and we'll walk you through if we think it's appropriate for you.
Yeah, absolutely.
Well, thanks for joining us, everybody, and we'll catch you next week.